Hello everyone, today I will explain you about basic accounting, especially about financial statement. So, stay tuned and don't miss it. Preparing financial statement is the 7th step of the 9-step accounting cycle. We will take a look at them first, so we have a picture of what we are trying to produce in an accounting system. Financial statement refer to a specific set of reports produced in an entity's accounting system. The objective of this report is to provide information about the entity. A complete set of financial statement is made up of 5 components: an income statement, a statement of changes equity, a statement of cash flows, a balance sheet, and the last is notes to financial statement. Let's check it out and see one by one. The income statement, or also known as profit and loss statement, shows the result of operation of an entity over a particular period of time. It presents the period's income and expenses and also the resulting net income or net loss. Many large companies today prepare a statement of comprehensive income because it presents a company's operations result and also its other comprehensive income. If company has no other comprehensive income, then the contents of the income statement and a statement of comprehensive income would be the same. Other comprehensive income include gains and losses that cannot be reported in the income statement, such as unrealized gains, translation adjustment, and revaluation surplus for a given period.
Here's a sample income statement of a service-type sole proprietorship business. Let's name the company Strauss Printing Services. All amounts are assumed and simplified for illustration purposes. An income statement shows the net income or net loss of a business, which is achieved by deducting all expenses from all income. A typical income statement starts with a heading, which consists of 3 lines. The first line presents the name of the company, the second describes the title of the report, and the third states the period covered in the report. Notice that the third line is worded for the year ended. This means that the income statement presents information for a specific span of time. Income accounts are presented before expenses. It's a good practice to arrange expenses according to amount from largest to smallest. Nonetheless, miscellaneous expense or sundry expense is presented last. If income exceeds expenses, there's a net income. If expenses exceed income, there's a net loss. Notice how computations are presented. A single line is drawn every time an amount is computed. The resulting amount is double ruled when it's no longer followed by any operation. The income statement complies with the accrual basis of accounting. Income is recognized when earned regardless of when collected. Expenses are recognized when incurred regardless of when paid. This means that income and expenses presented in the income statement have been earned and incurred, but it doesn't mean that they have all been collected or paid. Moving on from our previous illustration, here's a sample statement of comprehensive income, which includes other comprehensive income.
A statement of changes in equity shows the changes in capital account due to contribution, withdrawals, and net income or net loss. Capital account is increased by owner's contribution and income and decreased by withdrawals and expenses.
Here's a sample statement of owner's equity of Strauss Printing Service. Assume that the company started the year 2019 with $100,000 capital. During the year, the owner made $10,000 additional contributions and $20,000 total withdrawals. A statement of owner's equity shows the owner's capital at the start of the period, the changes that affect capital, and the resulting capital at the end of the period. A typical statement of owner's equity starts with a heading which consists of 3 lines. The first line shows the name of the company, second, the title of the report, and third, the period covered. The title of the report is Statement of Owner's Equity. This is used for sole proprietorships. For partnerships, the title used is Statement of Partner's Equity, and for corporations, a Statement of Stockholders' Equity. Notice that the third line is worded for the years ended. This means that the Statement of Owner's Equity presents information for a specific span of time. The capital account used in the illustration is Strauss Capital. The capital account used would vary from company to company. Income increases capital, expenses decrease it. Net income is equal to income minus expenses. Hence, net income would increase the capital account. If expenses exceed income, there is a net loss. In such case, net loss will decrease the capital account. Notice that the net income above $57,100 is the bottom line amount in the company's income statement. Strauss drawings represent the total withdrawals made by the owner during the period. The owner made $20,000 total drawings. This amount is deducted to get the capital balance. The statement of owner's equity example above shows that the company has $147,100 in capital as a result of the following: $100,000 balance at the beginning of the year, plus $10,000 owner's contribution during the year, plus $57,100 net income, and minus $20,000 withdrawals. Good accounting form suggests that a single line is drawn every time an amount is computed. The bottom line amount is double ruled.
A balance sheet shows the financial position or condition of a company as of a certain date. It is also called by Statement of Financial Position. Financial position pertains to the resources owned and controlled by the company, which is asset, and the claims against them, which are liabilities and capital.
Here's a sample balance sheet for Strauss Printing Services. A balance sheet shows the financial position or condition of the company. Thus, it is also called Statement of Financial Position. A typical balance sheet starts with a heading which consists of 3 lines. The first line presents the name of the company, the second describes the title of the report, and the third states the date of the report. Notice that the third line is worded as of blah blah blah. This means that the balance sheet presents information as of a certain date at a specific point in time. In the above example, the contents of the balance sheet pertain to the financial condition of the company on December 31st, 2019. A balance sheet summarizes the assets, liabilities, and capital of a company. Assets refer to properties owned and controlled by the company. Liabilities are obligation to creditors, lenders, etc. And capital represent the portion left for the owners of the business after all liabilities are paid. For detailed lesson about assets, liabilities, and capital, check out the elements of accounting. Assets and liabilities are classified as either current and non-current. Current assets are properties that will be converted into cash within 12 months or within the operation cycle of the business. Current liabilities are due within 12 months or within the operation cycle. Non-current assets and non-current liabilities are those that don't meet the above qualifications. Total assets and total liabilities and capital should always be equal. The capital amount $147,100 for Strauss Capital was actually taken from the statement of owner's equity. The balance sheet may be presented in two forms, account form and report form. In account form, assets are presented on the left side, while liabilities and capital are presented on the right side. In report form, assets are presented first and then followed by liabilities and capital. The example above is presented using the report form. Good accounting form suggests that a single line is drawn every time an amount is computed. It signifies that a mathematical operation has been complete. The total asset and the total liabilities and capital amounts are double ruled.
Cash flow statement shows the movement in the cash account of the company. It presents cash inflows and outflows in the three activities of business: operating, investing, and financing.
Here's a sample cash flow statement for Strauss Printing Services. Statement of cash flows presents the inflows and outflows of cash in the different activities of the business, the net increase or decrease in cash, and the resulting cash balance at the end of the period. Cash inflows refer to receipt of cash, while cash outflows to payments or disbursements. A typical cash flow statement starts with a heading which consists of three lines. The first line presents the name of the company, the second describes the title of the report, and the third states the period covered in the report. Notice that the third line is worded for the year ended. This means that the information included in the report covers a span of time. Cash inflows and outflows are classified in three activities: operating, investing, and financing. Operating activities refer to the main operations of the company, such as rendering of professional services, acquisition of inventories and supplies, selling of inventories for merchandising and manufacturing concern, collecting of accounts, payment of accounts to suppliers, and others. Generally, operating activities refer to those that involve current assets and current liabilities. Investing activities may be summed up as where the company puts its money for long-term purposes, such as acquisition of property, plant and equipment, and investment in long-term securities. Selling these properties are also considered investing activities. In general, investing activities include transactions that involve non-current assets. Financing activities refer to where the company gets its funds, such as investment of the owners and cash proceeds from bank loan and other long-term payables. The payment of such items are also financing activities. Generally, financing activities include those that affect non-current liabilities and capital. All inflows are presented in positive figures, while all outflows in negative. After inflow and outflows are presented, the net increase or decrease in cash is computed. Then, it is added to the beginning balance of cash to get the balance at the end. Easy, right? In simple sense, this report presents the cash balance at the beginning of the period, the changes during the period, and the resulting balance at the end of the period. Notice that the cash balance at the end, $21,000, is the same as the cash balance presented in the company's balance sheet. Good accounting form suggests that a single line is drawn every time an amount is computed. It signifies that a mathematical operation has been completed. The computed balance at the end of the report is double-ruled.
The notes to financial statement or supplementary notes provide information in addition to those presented in the income statement, balance sheet, statement of changes in equity, and cash flow statement. These notes contain disclosure required by accounting standard, supporting computation, and other information that may users interested in. That's all explanation about financial statement. Thank you and see you on the next video. Bye!